Hi, my name is Bill Brown with Smith Craine Finance in San Francisco. And today I want to take a little bit of your time to demonstrate a value analysis tool that has been created here at Smith Craine. This is what it does. It's using the same math that previous discounted cash flow models have used for the last 30 years. It's the same thing that the pension funds, life insurance companies, institutional buyers use. Now we've just made it a lot easier for civilians like the rest of us to go ahead and have this tool at our disposal. So the input side is considerably easier, and the net yield results are a lot easier to understand, and it also spells out actual cash flow. So it's all on a dashboard rather than in a series of paper, and that's really kind of the business case. It gives you an opportunity to deal with what ifs, changes, all the other things that may come up as you're trying to analyze a project. Here, of course, is the standard disclaimer. It's not a predictor of the future. Real estate is subject to any number of things that can happen to it, so you have to look at this as maybe part of the three-legged stool when you're appraising properties. This is the income side. Certainly the other two sides of evaluating the value of the property has to have equal weight. So it's math. If some of the scenarios play out, these are the things that you can expect to happen. So let's jump in. This is typically what we get. We start off with a phone conversation. A buyer may say, hey, look, I want to get this thing financed, or, you know, what can I look at here? What kind of yields, what kind of returns can I look at? I'm looking at a retail center. It's got about 15 tenants in it. He's asking $21 million. All I really know is a little bit about the expenses. And I know that there is an existing loan on the property. Can you help me evaluate this? This is what we can do. So we can start with simple zeros here. We have this whole thing entirely zeroed out, ready to go. There's nothing in here other than we preloaded the bulk of the tenant information, and frankly, that is the time-consuming portion. But I'm going to do this one really quickly. We're just going to call this one Super Center, and this is the center grocery. Let's assume that it has 61 and some change square feet. You'll notice that says 58% right there. That is the pro rata allocation to this anchor of the center. As you can see, as you add tenants or remove tenants, it adjusts that pro rata number. So let's go with the simple stuff. Let's assume that in July 1999 is when they signed their lease, and they got a little bit of an abatement period. And assume they started paying rent in October of the same year, and then this lease expires in June of 2024. Okay, we know we've got an option to renew. Let's assume that first month was $69.05. And then we'll do a couple of just quick bumps in here. Let's make this one for 6. Let's make this one, let's say that they're paying about 72. And then by 6 at the end of the term, maybe they're paying some neighborhood of 73. So you put in your rental information, then the start dates and stop dates of the lease. It goes ahead and values it for you. What type of lease? In this particular case, these are all triple nets, so we will put a net in that square. Just so you know, these can certainly do gross based off any combination that can be accommodated in these boxes. Here's the first time you really have to use some manual input. You take a look over here and see what the market has been established. If you can get up to about $14 after 20-some years, I think it's safe to assume that you might have a $15 market in the future. And then the start here of green cells, which are assumptions, we are saying that in this future market, we could be looking at 2.6 in inflation, maybe a 75% renewal rate. If it doesn't renew, 5 months of downtime, 1.5% escalation growth in rental asking rates, and then typically a 5-year lease. You add into that the costs of the tenant improvements and commissions. It calculates for you, at least in this particular case, every 5 years, that same scenario of losing the tenant, having to re-tenant the building, and the costs associated with it. Okay, so that's the time-consuming hard part to get in all just the factual information that would have come from a rent roll. So assuming we have that rent roll information and then this little bit of information in addition, we can go ahead and do this analysis. So let's start with what we know. We're asking $21 million. Okay? And then if we look down here, we're going to put that same figure so that we can start to see the spread between the asking price and what we're willing to pay based on this analysis. Okay, we're the loan guys, so we're going to go right into that bit of information. You know, it's an amortizing loan. I think it started in 4 of 2006. And the original loan amount was $16,250,000. So keep an eye on this number right here. I'll show you something. Interest rate, 5.25. And then we knew that this is a 10-year loan. So again, keep an eye on this number. This is going to go ahead and age it for you as soon as we put in the maturity date. So April 2006, let's assume that in 10 years that's 3/2016. So it's a 10-year loan. There's 5 years already used up on it and a little over 5 years left. So we know that this loan has been aged and this number changed up. Let's assume a 1% assumption fee on this. And we know now that this loan has expired within the analysis period. We're going to go ahead and start putting in what we think would be a possible future loan. So we just match up the ending balance and the ending date, and that takes care of that. If, however, we want to overwrite, we can do it in this cell here. Make that future interest rate, let's make it 7%. Let's burden this thing a little bit. And take it out through the end. Let's go ahead and make it 2.6. And that'll go ahead and take it the analysis. Maybe put another 1% on top of that just because. Okay, this thing is starting to go ahead and build for us already. This is the first look at under the hood at some of the assumptions that are being calculated ahead of time. 5% for vacancy, further burden. We know that we're going to have to be paying some reserves, so we're going to go ahead and calculate that. And then normally we'd take a lot longer time in our expenses, but just for the sake of time, let's assume that we know that somewhere in the neighborhood of $63,000 is going to be the tax when this thing transfers, or maybe we know that it's 32 cents a foot for insurance, or maybe we know that it's 3% of the gross operating income for property management. Nonetheless, you can do it any way you want. You can either write it in this field or use these calculators to make sure that it ends up over in this column. So, for example, I'm just going to go ahead and put 11% right here that will make up the remainder if we can. So that has now established the expenses and the expense ratio. We go to our basic tax calculation. Disclaimer, we are not tax people. We recommend that you go through a CPA or a 1031 exchange professional to get tax advice, but what we've done is burdened it with about a 45% burden, just to make sure you know that there are taxes due. We're almost done. The analysis has already calculated 6 of the 9 prices, so let's go ahead and just put in some manual ones. And let's try another rational approach here, maybe $230 a foot for this type of property. And then down here, it's just another way to round off and get a grouping of prices that is, within reason. And this does make sense within the next 1 to 10 years of a future pricing scenario. So I'm not real sure exactly how long we spent on that, but I just want to let you know that we have already started to calculate this analysis. But before we jump over there, just a quick look. These last 2 rates right here are basically backstops. They're very conservative. They're designed to make the analysis work hard to make its money. This is the weighted average cost of capital. It's measuring this investment against the blending of equity and debt. And then the band of investments theory, which is probably another hour seminar, effectively takes those same principles and adds in the loan constant. And as a result, you have a grouping of rational future pricing scenarios. So let's go and take a look at our results. You can see in 10 years at this optimistic future cap rate, which is not considerably lower than what you may be willing to pay for it, you're getting 11.42% return, leveraged. Now here's what this analysis does that some of the others do not do. You can start taking a look at different cap rate scenarios as a dashboard. or you can take a look at maybe a few years back and give it a second here because it's working through several calculations to go ahead and make its change there. But now we're taking a look at possibly a 9-year, let's get that centered for you, a 9-year future cap at 718, and it's changed all of these numbers. And what can you control as a potential buyer? Well, what you can do is you can go back in and say, well, I think that price is too high, which I think is the first instinct. So let's go ahead and make a differentiation between the asking and the offering price. Put that number there. And come back and take a look and see how this thing's performing now. Well, now it's starting to take a little better view. So let's assume that we are somebody who's going to hold this thing for maybe, let it be over to 7 years. A second. There it goes, 7 years. And this is the type of hold that we want to take a look at. We want to run through these various scenarios. So we're saying if we bought it at a 7.42, and maybe we can sell it at 702 or any other along these choices, we can start drilling into some of the detail. For example, in this particular scenario, if you sold it in year 7 at that 7.02 cap rate, you would be getting a good amount of money from your cash flow and roughly the same amount from potential appreciation and roughly the same amount from the amortization that you've earned from your loan. Again, this goes into your cash on cash. We're only looking at 8 years, so it drops up here, but you can see the results of the refinance. This one is an actual microcosm view of the entire tenant mix. And what it's telling you right here with these red bars is that a certain percentage of your tenants are expiring. And cumulatively, they are starting to add up. You can get into much more detail on that by hitting the rent roll and going into that detail. Here's a 10-year cash flow that gives you an indicator of your cash-on-cash reduction, or cash-on-cash before and after debt service and principal reduction. Kind of a view of your economic loss to see if there's anything that's controllable, and then, of course, your markets, and then all of your static indicators available here, square foot by square inch by square anything over any period of time, just about any metric that we've ever been asked to provide along some definitions. All of that came from roughly about 10 minutes of entry. Now, that being said, our apartment, our storage, our student housing, a much smaller input side. Obviously, you don't need the detail that's required for retail, office, and industrial, where you actually have fixed leases. So, effectively, I think we've stayed within our time period. Again, this is what it doesn't do. It doesn't predict the future, but it at least helps you do the math if you want to take a look into the future. And this is what it does do. It gives you the same math capability that the big guys are using. It's a whole lot easier to use, and you're getting the same results. So, with that being said, this is me. My name is Bill Brown, Smith Craine Finance. Thank you for your time today, and I look forward to hearing from you if you have any questions or we can help you work on any ideas. Thanks for your time.